Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Scrolling through the comments through here, I was going back and forth, all around, up and down. And, I wanted to talk about a topic that I think will help a lot of people. So when we invest in a lot of these companies, they are commodity companies. These commodity companies, if you're trying to make outsized returns, you can't look at it from like valuing a regular business that can control its selling price of whatever it is. Because we're investing in an opportunity that may not have a good looking balance sheet at this time. We are looking at the commodity, we're looking at the future, and what we're doing is we're looking at companies that don't look good today, but have money flows coming in through some volume, through technical analysis. And we are speculating on the price turning around. And the opportunity that we're going after is so asymmetric where I can risk 50, 100% of whatever I put down in it, the portfolio position size, but it could return 25 to 100 times its potential, it could earn up to 25 or 100 times of whatever I put down. And that's what makes commodity companies so fun and so rewarding, because that can happen very quickly, much more quickly than any other sector there is. But there are times where things go the opposite direction and they go bankrupt. That's why we specifically limit our portfolio position size to certain areas. It's part of the holistic thing of setting this up. It's not, hey, this looks good, and then just pile all your money into it. You got to look at each thing as this is a part of a plan, a part of a strategy, and the symmetry is part of that strategy. Portfolio position size is part of that strategy. So, what I'm wanted to talk about is the companies today may not look good, but we are projecting that future cash flows could be insane, like ridiculous level differences from where we are today. That's exactly what I did with SM Energy, QEP, CDEV, Crew Energy, and all those other ones, because what a good investor can do is they can see the future before it happens. They can make accurate predictions. They can make, it's not really even predictions. They can make projections, perhaps. They can see situations where you can get squeezes in certain areas. And the way that I've been doing this, and I'll just kind of let this, I'll talk through some of my process or strategies as I can think them up. Why I invested so much in oil and natural gas in the beginning. Why did I take that bet? What did I think? And a lot of you guys who've been on the channel for a while, I'm sure you understand why I did it, because I was saying why I was doing it while I was doing it. But there's a lot of people who obviously on the channel, they've never seen any of those videos. I'm just going to kind of recap my approach. We had the ratio go to some ridiculous level. In fact, I'll pull it up real quick. And that ratio, like, and I'll be honest, guys, like, I couldn't sleep at night because I had problems, because I knew the risk reward was so in favor of anyone who took this bet that I was kind of just, I don't know, I was like dumbfounded by it. So what I'm pulling up is the gold future to crude oil futures. This is a ratio, and more specifically, I'm talking about this ratio here, where it went absolutely berserk. And when we shut down the economy for the medical event, and we had all of this oil flowing, and it just screwed up absolutely everything from the supply side, because demand got shut off or was drastically reduced, and supply couldn't just be shut off. So we were left with this ratio that just looked ugly as heck. But since I knew ratios, I was like, well, now's the time to get into crude oil, all in this general vicinity over here and up here. And what I was doing is I was not just looking at the ratio, but I was projecting. And this is what I think everyone has to start doing. to be a really good investor. And I'm not saying that I'm necessarily this best investor of all time, okay? But this is what I did. I said, okay, they shut this down, right? It wasn't a recession. It's kind of like when you look at things, um, was it strong before it was shut down? The answer is yes. We had liquidity coming into the system, not anything near what we had from the stimulus stuff. Liquidity was coming in the system. Interest rates were wanting to go up. That's what 2018 was, and we were in the middle of an expansionary phase of real estate. Like you have to understand where we're at. They chopped this thing, and then they created this buying opportunity that's behind me, where the ratio went completely crazy. And then we were, in my opinion, we were going to reopen up. And I was like, demand's going to be huge. It's going to be huge. Why is this demand going to be huge? Because we didn't have a sick economy to begin with. We have a strong economy. And what I mean by economy, I'm talking about money coming into the system, is what I mean. Expansionary phase of real estate. The liquidity is strong. So I was looking at this and I said, wow, we just had a huge problem in oil. Huge problem. And this problem is going to exacerbate things to the upside because the oil companies were hurting for a long time. They had to cut back. They had to cut back spending. They had to cut back investment. They cut back everything. So on the opposite side, if the demand remains strong, well, demand will come back really quick, but the oil can't. They got in a situation that was really bad for them. So I didn't think that the oil could come back as quickly as the demand could. And that's proving quite right. So what you have to do is you have to see kind of the situation and then project the situation forward. And accurately project that situation forward is where you can make a lot of money. A lot of money. In this trade, if you could get the bottom of it, you've got some 25 to 50 baggers already out of it. And that could go up 4 or 5 from there. You're talking multi-hundred bagger returns if you could buy it at the bottom. How could you buy that at the bottom? What could provide the know-how and the knowledge to accurately project forward what's going on with this? And you have to look at the market conditions. You have to look at the ratios. I tied the ratio here. It went to a ludicrous level. Then you look at the market conditions. The market conditions were we stopped this by a humankind stopped this. This wasn't necessarily something where it was a disaster. I mean, yeah, we had some problems, but humans decided to stop it. It wasn't an external force or war or something like that. So I thought that the demand could come back. Now, if you can look at things from that perspective, I think you could become an investor. And what I've done with natural gas even. So we've had an energy crisis, and I've done this a lot on the channel before. We have an energy crisis over in Asia. We have an energy crisis in Europe. Well, if everything is interconnected, if we're all nodes in this big world, nodes, I said, N-O-D-E-S, nodes. If we're all nodes in this world that are all interconnected, what are the chances that that very high natural gas prices are going to come to America? They're going to have to get bailed out somehow, right? This energy has to come from somewhere, from the way that I view things. So, I mean, I did get one thing wrong. I went heavy into natural gas. I went very heavy into natural gas. I did not go into coal as much because I thought that coal was a little more risky, but that turned out to be incredibly wrong. That bet was huge. Would have been a great bet. But I'm still killing it in the natural gas area. And I still think natural gas is still a better bet, just based off the leverage in the past. But coal was a really good bet. It was. And the one thing that you can do is you can look around the world. You can see where shortages are starting to develop. And if it hasn't developed in another area of the world, but it's starting to spread, that's an opportunity. And that's kind of how we're playing this. We're playing the oil, natural gas in America because I think it's going to spread to America and pull those prices a lot higher through liquefied natural gas, through terminal builds and all this other stuff. And that was another play, Tellurian. I thought with the increased prices over in Europe and Asia, and with our terminals being basically maxed out, liquefied natural gas terminals, that there was an excellent opportunity to buy a company with a management team that's already done it, to build a liquefied natural gas plant. That makes sense, right? It's 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 about accurately predicting, or it's accurately positioning yourself for things that have already happened somewhere else that could have a high probability of happening where you're at. So though that's another area that I think there's large opportunity for investor improvement. Now we've got other things that are coming. We saw that natural gas had problems over in Europe. I saw that fertilizer was going to have a problem, so I bought what I thought were two solid companies. One was kind of a higher cost producer, so to speak, like Intrepid Potash. The other one was Mosaic, which is a good all around company. Nutrien would have been another one to get. That's a really good, solid all around company. But that's another trend that you could see before it kind of happened. It was happening somewhere else, and then it's projecting like, hey, this is going to spread. There's other trends that are happening right now that I'm positioning for on our website. I think a lot of you already know what some of these trends are, natural gas being one of them. But there's other trends out there that I'm also positioning for. So, being a good part of an investor is to accurately identify trends that are coming ahead of us, knowing what's cheap, and then trying to figure out how to play it. The figuring out how to play it doesn't necessarily mean that the balance sheets will necessarily look the best. What I am talking about is it's about the trends that are that haven't materialized yet, and companies that may be, we'll say it, the greatest potential companies, which are usually high cost producers, or these fringe companies where they go ballistic when the price goes to a certain level. They just go ballistic. Those are the ones that I really like. Those are the ones that, everyone kind of hates them. You go into a sector, everyone likes these like 7 different companies. Now everyone's piled into those 7 companies. And let's say these 3 over here nobody likes. Those are the ones that I'm buying in mass. I don't know why, I just do it. And then for some reason, these 3 companies end up blowing past everyone else because they're high cost producers, because they carried too much debt, because XYZ, the company diluted shares, whatever it is, their project is too costly to finance and doesn't matter because the Chinese are going to buy it out anyway. But those seem to be some of the best. So it's not just accurately identifying trends and then going to see kind of what companies there are. I'm almost like doing opposite of everyone else. I mean, that's literally what it is. I'm like the contrarian within the contrarians within the contrarians. It's like, it's contrarian to buy uranium at its bottom. And then it's like you go there and all these people are buying all this. So you're going to buy all the other companies that nobody, like they really didn't like Bannerman at the bottom. And then I'm like, my biggest position sizes are the ones that everyone else is telling me I'm crazy on. I don't know. So I kind of just, it's like a double contrarian or triple contrarian play. And sometimes that pans out very well. Sometimes it doesn't. Sometimes it doesn't. So it's accurately identifying trends. Accurately. You got to get your head screwed on straight. You got to be able to read information correctly. And then once you have that trend, it's to look at companies from a way where you think where they're at today, where the largest projection of cash flow could be in the future, and the difference to the bottom line, the earnings per share. The earnings per share could grow the greatest if you want to play the leverage game, if you want to play that game. And you're going to have to be looking at companies a little bit differently. And the way that I look at them is you look at them, you say, okay, this one's got a lot of debt. Can they pay it off? Do they have more lending that they have so that when the commodity turns around, those debts will be inflated away through the commodity? And I would say that a lot about oil and natural gas. So they have to live long enough for their debts to be inflated away through the commodity price. And some of those bets turned out pretty well. And I used technical analysis and volume and all that stuff to kind of help me or guide me into some of the companies and using fractals. And when companies move violently up and down, they're usually the ones that are the high cost producers, especially if they're below the cost curves. And the price of the commodities going above and below the cost curve break-even points. Sometimes they go kind of crazy. But you kind of just got to hold on. And you got to have that confidence. And I know a lot of people, they want to join the website or they want to join the channel for mentorship or for someone to help them through this commodity bull market. And you know what? That's a very smart move. It is very smart because I wish I had someone to help me through it when I was younger. And here's my plug, guys. If you want to sign up, platinum membership to the Finding Value website, that's something that I'm going to help everyone through, is getting through this commodity bull market together. And I wish I had someone. I wish I had someone to accelerate my learnings faster than what I did. Someone to make me, I don't have it in my personality trait to be scared out of positions. What I had is I just had the wrong companies, wrong time. I was just messed up on everything. And you only get these things every once in a while. They don't come along but a few times in your lifetime. That's all you get. We might get 10, 15 years out of this. Then you have a 10 or 15 year down thing. So that's 30 years. So you better have the right companies. You better have the right mindset. You better have the right sectors. And I think a lot of people on the channel figured this out. I've been sharing quite a bit on the channel, gaining a lot of trust in myself, gaining a lot of trust in yourself. And we'll get through this. We'll identify some really good companies. And as long as we use a strategy, as long as we use portfolio position sizing and allocation sizing correctly, there's going to be a lot of good winners in our portfolio. So give me a thumbs up for the content, guys. Subscribe to the channel, subscribe to the website. Platinum membership gets you everything. The information or education, and also the stock picks, and you can see what I own in my own portfolio. I'm going to have to update that here too, because I just bought some other companies. But yeah, that's what I've got, guys. We'll see you next time. This is Finding Value.